Welcome to the Daily Drawdown, your fast brief on SpaceX, oil, rates, and market rotation. The market got three pressure points at once: a blockbuster IPO pipeline, an oil shock, and bond yields back in the danger zone. That combination matters because it changes where money goes, how fast inflation cools, and how much risk investors are willing to carry. SpaceX is shaping up as an unusually structured IPO, with reports pointing to a fixed $135 billion share price and a headline valuation near $1.77 trillion, while other coverage frames it more like a roughly $75 billion public debut. The practical point is the headline number looks enormous, but the actual public float appears much smaller, around that $75 billion range, so passive index impact may be far lighter than the valuation headlines suggest. Demand looks extreme. Some reports put order interest near $250 billion. The deal is said to be about 4 times oversubscribed, and retail could get roughly 30% of the allocation, far above the norm for a mega offering. That combination increases aftermarket risk. A thin float, heavy retail participation, and no traditional quiet period structure can make early trading much more violent than the valuation story implies. There are already plans for levered products tied to the stock, which is another warning sign. Those are trading tools, not long-term vehicles, and they can amplify the first few weeks of price swings. SpaceX is not arriving alone. Anthropic and OpenAI are also in the conversation. And a cluster of giant offerings could pull a lot of cash out of the rest of the market at the same time. That helps explain why investors have been trimming crowded AI winners. Some of that is simple profit-taking, and some of it looks like cash being raised for the next issuance wave. The debate is whether markets can absorb it cleanly. History says strong demand often supports big issuance, but surveys and desk commentary also say available cash is not deep, especially with sovereign and corporate borrowing still heavy. The Iran escalation pushed oil sharply higher, with WTI moving into the mid-80s to above $90 in several reads, and that is the most immediate macro risk because energy moves hit consumers fast. Energy was responsible for more than 60% of the monthly CPI increase in multiple accounts, which means even if core inflation stays contained, headline inflation can reaccelerate quickly when crude spikes. The supply story is not just crude. Analysts are flagging refined products like diesel and jet fuel as the tighter part of the chain, and those shortages can bite harder in the near term as summer demand builds. There is also a strategic layer. Iran has economic incentive to keep Hormuz traffic flowing because toll revenue matters, so the path is not necessarily straight to a full shutdown, but the upside price risk stays elevated while the conflict remains unstable. The SPR is still near the low end of its historical range, around 350 million barrels, which limits how much cushion policymakers can credibly project if the disruption worsens. Latest CPI readings put headline inflation around 4% to 4.2% year over year, the first move above 4% in about 3 years in several reports, while core is closer to 2.9% and monthly core prints remain around 0.2%. That split matters. The Fed cares much more about core and broader persistence than a single energy shock, so the oil spike raises pressure but does not automatically change the policy path. Markets are still conflicted. Futures have shown meaningful odds of additional tightening later this year, while some strategists are already looking past that and arguing labor softening could open the door to cuts in 2026. The labor nuance is important here. Payroll headlines still look decent, but hiring expectations and survey data are weaker, and participation remains soft, so there is a real argument that the economy is cooling underneath the surface. What to watch next is whether higher fuel costs bleed into food, transport, and services. If it stays mostly in headline energy, the Fed can look through more of it. If pass-through broadens, that gets harder. At the same time, the 10-year Treasury is back around 4.5%, which is a level that tends to pressure duration-heavy equities and raise the bar for risk assets across the board. Behind that move is a straightforward supply problem. The U.S. deficit is running around $1.2 trillion year to date. Net interest costs are at record monthly levels, and government borrowing needs are still growing. Higher yields are especially tough on capital-intensive sectors. They weigh on non-yielding assets, and they force equity investors to demand better earnings quality instead of paying up for distant stories. That is exactly why the AI trade has cooled at the edges. There has been a broad rotation out of overbought chip names and into healthcare, financials, industrials, and parts of real estate. Micron, AMD, and Marvell have taken pressure, while retail flow data show multiple days of selling in QQQ, SMH, and individual AI names as investors raise cash or de-risk. The more durable AI theme still looks tied to infrastructure rather than pure model hype. GPUs, server builders, and enterprise integration stacks are where buyers still see clearer revenue visibility. Supermicro is a good example of the stress in the trade. It announced roughly a $7 billion raise to fund AI server inventory, and the stock sold off hard, a sign the market still wants the exposure, but is getting stricter on financing and execution. NVIDIA remains central to the chain, but leadership is narrowing, and the easy part of the momentum trade looks over for now. Oracle reinforced that same message. Revenue was roughly $19.2 billion, and remaining performance obligations surged to about $638 billion, showing very strong AI and cloud demand. But the market is focused on the funding side too. Oracle outlined plans to raise about $40 billion for fiscal 2027, and that renewed scrutiny on cash flow after commentary around negative free cash flow. Demand is there. The question is how much capital it takes to serve it, and in a 4.5% treasury world, that matters a lot more than it did a year ago. Volatility is elevated but not disorderly. The VIX has been running higher, put-call activity has picked up, and the cleaner read is that investors are hedging while the market reprices inflation, oil, issuance, and rates all at once. Breadth is actually better than the headline indices suggest. Mega-cap concentration still distorts the S&P, and equal weight measures have at times held up better, which tells you this is also a rotation story, not just a broad risk-off move. One other area to watch is prediction markets and sports betting. The CFTC is drafting rules that would restrict or ban event contracts tied to things like war, terrorism, assassinations, and injuries, focusing on manipulation risk and public interest concerns. That could slow product rollout and invite legal challenges, but the commercial backdrop is still strong. Analysts see about $50 billion in global handle for the 2026 World Cup, with major upside for FanDuel and DraftKings has already posted strong growth in its predictions product. In defense, the notable development is operational proof. The U.S. used an autonomous maritime drone to recover downed pilots, the first confirmed combat theater rescue of that kind, which is exactly the sort of real-world validation the autonomous systems space needs. The larger theme is deployment speed. Defense executives are putting the emphasis on decision velocity, meaning faster procurement and coordination, because scaling autonomous platforms and munitions is now an execution challenge as much as a technology one. The big watch list is simple. SpaceX pricing, oil through CPI, and whether 10-year yields stay pinned above 4.5%. If those three keep moving the wrong way, rotation and volatility probably continue. This is the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.